Some order then.
Order, and good morning, and welcome to the final Treasury Committee evidence session on retail banks. We're joined today with UK CEOs from 4 major high street banks in our all-important banking sector. So I'm going to start by inviting our witnesses to introduce themselves, starting with yourself, Charlie.
Charlie Nunn, the Chief Executive Officer of Lloyds Banking Group.
Paul Thwaite, Chief Executive Officer of NatWest Group.
Morning everyone, Mike Regnier, Chief Executive Officer of Santander UK.
Good morning, Maru, CEO of Barclays UK.
Great, well it's been I think just over a year since we last saw your organisations in front of this committee, and at that time you were preparing for the implementation of the consumer duty to be put in place by the end of July, and you were working hard on that. So now that we're a few months into the consumer duty, how have you changed your businesses? What would our constituents be seeing different in their lives from this consumer duty, Charlie?
First of all, thanks for having us back this morning, Chair. Yes, as you say, we implemented the first stage of consumer duty last year in June last year. That was focused on new products that customers were buying on the front book, as we would call it, not existing relationships and existing customers. That next stage is happening in July this year, so it's early stages, and we're both focused on making sure we're bedding down what we've done in June last year and implementation for June this year. In terms of the kinds of changes that we put in place, as you know, the focus really was on ensuring customers have good outcomes, not just from the point at which they first build a relationship with us, but on an ongoing basis. And we put in place actually a large number of changes, but for example, made it easier for customers to see terms and conditions and understand the products they had in place. We looked at how we engage customers and onboard them and make sure they understand the services they're having. We've put in place enhanced communications to ensure that customers are using products safely. So an example, we knew that customers of credit cards would sometimes use their credit cards at ATMs and get charged higher fees. So we did additional disclosures to make sure customers are really aware about those fees. And we've been tracking whether customers are reducing their usage, for example, of credit cards in those moments. And then we've put in place a whole set of information so that our teams can make sure customers are getting the right outcomes. And if we see areas where we're concerned about those outcomes, we're doing proactive outreach to customers. And that's been really helpful, actually, given all of the challenges our customers have had in the last 12 months around things like cost of living.
I'm sure we'll come back to what those areas are. Paul, congratulations on your appointment. What are you doing differently for our constituents since the consumer duty was rolled out for new customers?
Thank you, Chair. I'm a big supporter of consumer duty. I think the principles and the key objectives of consumer duty are very aligned with how I want to lead the bank. We've invested in extensive training for our colleagues to make sure they all understand consumer duty, its principles, the importance of good customer outcomes. In terms of changes specifically, Chair, a lot is similar to what Charlie discussed. We've invested a lot of time in improving communications, in improving the customer experience, often spoken about in the context of customer journeys, making sure the journeys for customers are very transparent and they're very clear. We've reviewed all of our on-sale products, which is about 300 products, from the perspective of consumer duty to make sure they're driving good customer outcomes. And we've also reviewed our off-sale products, which is around 200 products. So quite a lot of review, a lot of communication, and a lot of training for our colleagues.
Okay. Anything different from you, Mike, at Santander?
Very similar approaches, actually, to what Charlie and Paul have just described, actually, Chair. So the most important thing for us is looking at the outcome that customers are getting from the products that they have and the service that we provide for them. And we've looked at all of our products, as has already been mentioned, to look at the outcomes that they're delivering and all of the processes, particularly for vulnerable customers, actually, to look at the processes and how actually the service that they're receiving, whether it's what we were expecting. So just a couple of extra examples to add on to the ones that we've already heard. So definitely we've done a lot around training, we've done a lot around making sure that customers get more information and that we try and make sure they really understand the information they're getting as well. A couple of examples. So for frequent, Charlie talked about customers with credit cards taking cash out of ATMs. We've done a lot of work, for example, with persistent overdraft users who potentially might be better off consolidating that debt into a lower cost form of debt in a personal loan, for example. So write to several thousand customers to say this might be a better solution for you. And actually we've seen quite good take-up of that. So examples like that have been quite common for us. And we've also done a lot on looking at outcomes more generally. So we've already been doing an awful lot of work as banks on looking at root causes of complaints. That's been something that's been well embedded for years, actually. But we're doing a lot more. So, for example, we're looking at the root cause of cancelled products now. So a customer takes a product, they then cancel it, and we're trying to understand, well, why did they do that? Was that because it wasn't suitable? Was that because it didn't meet their expectations? And that, again, that gives us insight into product design, how we communicate at the point of sale, the follow-up communication that we're doing as well. So it's just more information to help us make better decisions on a day-to-day basis.
Okay, and Vim, has Barclays done anything different from those examples?
Very similar themes. I think I'd pick out 4 additional points, I guess. One is a lot of focus on training from a cultural perspective, making sure that customers are at the heart of our thinking and our decision making. Secondly, around product simplification, trying to make our products simpler, so we've reduced the number of products on sale to simplify that. That's also in advance of the closed product work that we need to do by July. The third is around communications, and I think one of the big changes from Consumer Duty, there was a lot of focus on consumer disclosure in the past. Consumer Duty moves more focus on consumer understanding, and so a lot of testing of our communications to make sure that customers understand what we are communicating. And then finally, on data and MI, there are dashboards now in place where we will learn. And Consumer Duty is sort of, it's a beginning of the process from July last year. We'll keep learning, looking at the data, looking at the dashboards, and taking actions from complaints, but also many other aspects in our dashboard around how people are using our products and services.
So it sounds like from all of your organisations there was a lot of change, and that, you know, Parliament asking the regulator to look into this Consumer Duty has generated some different behaviours from your organisations. So I guess my next question is, do you think you've had enough clarity from the regulator as to what successful implementation of the Consumer Duty looks like, and would you say that you have now done it? Has the regulator been clear enough?
Maybe, Chair, if I take that first.
Go ahead.
First of all, I'd say there's been, over the course of the last 12, 15 months, very proactive engagement with the FCA and the regulator. I think there's been very helpful forums where banks can raise questions or concerns and seek clarity. I think the clarity has improved over that period. And I'm pleased to say there still is opportunity to liaise with the FCA, both from the top of the FCA and the working groups. My teams spend a lot of time with the FCA. The FCA have visited our teams, both in London and in Edinburgh, and that's an opportunity really to ask questions where further clarity is needed. I think that process, as Charlie alluded to, we're in many ways halfway through the process, so I think that engagement will need to continue because there are still questions of clarity. I think that will emerge over the course of the next 12 months as we learn more in terms of customer responses, and also as the Chief Executive of the FCA said last week, I think, to make sure there isn't any unintended consequences. I think we're all very mindful of that. The principles are very sound. We need to ensure there aren't any unintended consequences around reduction of product availability.
Speaking of unintended consequences, and does anyone else want to just, you're all agreeing that you've had enough clarity, does anyone want to take a different tack than Paul?
Not a different tack,
no.
But I started by saying, obviously we fully agree with the direction of travel, but it is early days and it is a principles-based regulation. So some of the things actually my colleagues have talked about, Vim was talking about the MI we have, so we can really look at how customers are responding to what we're doing, and we're making sure the outcomes are good.
MI, management
information, apologies, yeah. Chair. I think that's really important, and the spirit of the engagement that Paul talks about with the FCA needs to stay very, very open. And then obviously as we go forward, we have to be very sensitive to what our customers are saying, what the Ombudsman is saying, and how that's feeding back into the interpretation, because it is a principles-based regulation.
That was going to be my next question in terms of the Ombudsman, but Vim, you wanted to come in.
I was just going to say that I think there's been a lot of focus on implementation during the course of the last year. There's been a lot of bilateral engagement that Paul touched on, which has been very helpful in giving us input and guidance. I think the horizontal work that's going to happen, which looks at what does best practice look like in the market, things we can all learn from each other, there are real opportunities, and I think the Vulnerable Customers Review is one example where I think we'll find a very helpful guidance that will come out of that.
And mentioning the Ombudsman, I mean, it is early days, isn't it? Have you had any cases go to the Ombudsman on implementation of the Consumer Duty yet? So that's still an unopened book as to how the Ombudsman is going to interpret cases that they may get about the Consumer Duty. Okay. All right. Just in terms of Nikhil Rathi's speech last week, where he spoke about the free-in credit banking model, I guess it did raise the spectre that potentially the free-in credit banking model, which the UK uses very widely, might change based on the interpretation of what he said in his speech. So can all of you rule out over the next year changing your main current account offer, and you're not planning to move away from that free in credit banking account model, are you?
Yeah, we can rule that out for Lloyds Banking Group.
Okay.
Yeah, we have no plans to change the free banking model. And I think the point Nikhil was making was a slightly broader one around, it's for the, I guess, banks and market participants to decide what their kind of strategies are around products and pricing, but we have no plans to change.
Okay, Santander?
So we already offer a range of current accounts today. So we have basic bank accounts, we have free versions of current accounts that come with a certain number of features, but not everything. And then we have, in our range, we have a number of paid-for accounts already, which have modest fees each month, but in return you get cash back and interest and things like that. So I think the free in credit is, as we all know, is quite a difficult thing to describe because there are fees associated with accounts for typically for debit card usage or for whatever. But in our case, we already have a range. We've got no
You're
plans
not
to do anything
closing that
different.
option down.
No, we've got no plans to do that.
And Barclays,
And exactly
you can rule
like
that out.
Mike, we have a range of products and services, including free options for customers, and it's customer choice which product and service they want to choose, and we have no plans to change that.
Okay, that's very clear. Drew?
Thank you. Good morning. We've noticed previously that interest rates, or mortgage rates I should say, are very, very quick to rise when monetary policy tightens. Why have mortgage rates gone up so recently when the Bank of England base rate is forecast to come down this year? Do you want to start, John?
Excuse me. So obviously, as you know, mortgage rates peaked initially after the in the end of 2022 during the Truss period, and then they fell through last year, and then they peaked again, I suppose, in Q3 last year in 2023. We've actually seen them declining from December, and they've declined really quite significantly from the peak last year, up to 1.5% for our customers, which was really important, even though the base rate was staying stable at 5.25%. And then in the last month, 6 weeks, they've gone up slightly again, not got back to the levels they were at. That's because...
That's the question, though. Why has that gone up again?
And that's because we have to price mortgages to ensure financial stability based on the forward-looking, it's called a swap curve, but it's the interest rate swap curve, which is linked to the duration of the mortgage. So most mortgages in this country, customers are looking either for a 2-year fixed term or a 5-year fixed term. And we have to price based on the expectations of inflation to make sure that we're not exposing the system to any instability. So the great news is mortgage prices can come down ahead of the base rate. That's what we're seeing. We're still below the pricing we saw at the base rate last year. Yeah, but we are obliged to respond.
Can you explain the lag then between the two? Because you know the rates are coming down. Why have rates gone up? And why is it going to take a longer time for them to come down?
Yeah, so sorry, maybe I wasn't clear. Actually, mortgage rates came down way ahead of the base rate. So in December, January, you've seen them come down 1.5%.
You've just described them going back up.
And they've just gone up again,
yes,
but not as much in response to that same pricing, that 2- and 5-year pricing. So we have to price based on the risk and the duration of the mortgages. Otherwise, you'd create an instability in the market. And so we're looking constantly at those forward-looking pricing curves. And those swap rates, as they're called, have increased since January by about 80 basis points, or 0.8%. So we have to put that into the pricing. It's still lower than it was at the end of last year, and it changed ahead of the base rates. What will be really important for our customers, obviously, as they look forward, is thinking about how expectations around future rates will change. And we all actually have guidance which we've used as our macroeconomic forecast around this. And our outlook is that base rates will continue to come down. And our expectation is that the forward curves should also continue to come down. But there will be volatility on that journey.
Okay, I take it you all agree with that, but can you, what can you demonstrate to us? How can you demonstrate to us that the mortgage market is competitive? It's a competitive market that's serving its customers well?
I would. Yeah, so I'd say, Mr. Henry, is I think it's a very competitive market. I think the rate of product and pricing changes in the mortgage market is considerable. You can see on at least a weekly basis, sometimes a daily basis. I spend a lot of time talking to customers and brokers, and they talk about how frequently the rates change. And you can see that the margins in mortgages across the majority of the banks are very tight and very thin. So it's a very competitive market. There's over 100 providers of mortgages. It's a market that's heavily disintermediated, so intermediaries will search out the right product and the right price for their customer. And given the pace of change in rates, to me that's a very healthy indicator of a very competitive marketplace.
Well, you said it's both tight and competitive there. What percentage of your customers are switching provider at remortgage?
Percentage?
What percentage of your customers are switching provider at remortgage time?
So that varies depending upon which rates customers are rolling off. Just to put it in context, 91% of our customers are on fixed rates, and in this particular year, 250,000 of those customers will roll off those rates. Around 2/3 of customers, from a NatWest perspective, would take a new product with NatWest, and others would take a product in the market.
About a third would switch. Would that be a common figure for all of you?
I'd say our pricing is very competitive, and therefore we see slightly less than that because people choose to stay with us because our pricing is very competitive.
Ours is around a third as well. This is a market, as Paul and others have said, this is largely intermediated. So a customer wants a mortgage will go to a mortgage broker. Typically 80% of the market now is driven through mortgage brokers. And those mortgage brokers have access to all of the criteria, lending criteria for all of the different lenders in the market. And there are tens of lenders in the mortgage market. Every price for every product that they have that's live at that moment and available for sale to customers at that time. And their job as an intermediary is to find the best product at the best price with the best service to meet that particular customer need. That is a very competitive market setup because literally a few basis points, so hundredths of a percentage point, can make the difference between whether one lender gets the mortgage from that customer or whether it goes to another lender. And prices change every week in this market. It's fiercely competitive.
Okay, going back to the volatility in mortgage rates, then just for a second, could the Bank of England have been clearer for you about future monetary policy? Would that have made a difference?
I introduced swap curves, so apologies, it's probably on me to talk about it. Obviously the Bank of England has an impact, or the MPC, and around the forward expectations around rates, but the forward expectations around rates are a volatile thing by definition. They're driven by market sentiment and expectations.
Understood.
Geopolitics.
Have they been clearer?
The political environment. I actually think the MPC's been pretty clear around their expectations, and that's not what's driving the volatility. In this context, the benefit that we saw in December was actually largely driven, I think, by the Fed and by the US, where they guided towards a significant number of rate cuts in 2024. And that made all of the markets in the world think that inflation and rates would come down quicker. And that was the really big determinant of what we saw as the volatility down. And then the slight strengthening when the Fed changed its guidance around this just in the last 6 weeks.
Let's focus back on customers then. The mortgage charter, which was agreed between you and the government and the Financial Conduct Authority, has been in force for about 6 months now. What's your assessment of its performance to date?
Maybe I'll start. So helping borrowers who are resetting fixed rates, I recognise that interest rates have gone up for them over the last few years. So when they come to the end of their fixed rate period, they will see the cost of their mortgage go up. So helping support them has been a really important priority for us.
How many mortgages are in arrears? How many people are being prevented from going into arrears by the Charter?
If I try and just work through just a couple of things, I guess. One, we've done a lot of work around communications with customers, helping them get on top of things earlier. So we've communicated earlier, multiple times, to help them prepare for the change that's coming. And then we have a range of products and forbearance tools, including the mortgage charter, which has helped people to adjust with interest-only options, as well as term extensions. And what we've seen as an outcome of that is arrears rates have remained below 1% for us.
Right. Okay. So
and that's below the market average.
Is that a common? Again, what would you add to that, Mike?
So for us, our overall level of arrears on mortgage customers is 1.6%, so slightly higher than Barclays. Actually, in our case, most of that is driven by lending that was done before the financial crisis, because the criteria for lending then were very different to the criteria that we've used over the past few years. They're now much tighter. We do a much better job of assessing genuine affordability, whether customers can genuinely afford to repay that mortgage or not. And if they can't, we obviously don't lend to them. So most of the arrears is driven by that historical lending, definitely not by the more recent lending. And just to give you an idea, last year, obviously a proportion of our customers came to the end of their fixed term, because like other lenders in the UK, 50% of our mortgages are on 2-year terms, and 50% of them typically are on 5-year terms, and 90% of our business is fixed rate, and only a small proportion is variable. So those customers that came to the end of their deal, they were typically being offered prices that were higher than they were paying before, because we saw the big increase in bank rate and the increase in swap rates that Charlie spoke about. And the average increase in monthly payment for customers last year that remortgaged with us was £220 a month, on average, which is a lot for many households, obviously. And so our job as a lender is to make sure that we're providing support to make sure that we can identify the types of customers that are most likely to be most impacted by that, and we can then provide the support that we need to them, whether that's taking out one of the mortgage charter options. And in our case, 10,000 customers have taken one of the mortgage charter options. 90% of those have taken a temporary interest-only extension for a 6-month period, and obviously some of those customers are now rolling off. But we've been providing support in many other ways in terms of proactively reaching out to those customers. And of the customers that moved last year onto a new rate, which was on average £220 extra a month, only 1% of those customers are now behind on their payments. So it's less than the average for the book as a whole. Okay. And that's partly thanks to this mortgage charter.
What more could the charter do to help customers from falling into distress?
I think the charter does what it's designed to do, and the job that we all do day to day is to make sure that not only are we there, but we're proactive in identifying which customers we think might need help. So in our case, for example, last year we identified 2.5 million customers that we believe might have some characteristic of financial vulnerability, and there are lots of different indicators that we use to assess that. And we proactively reached out to those 2.5 million customers to say, this might or might not apply to you, but there are things that we can do to help, and if you'd like to talk, then please ring. That's the most important thing that you could do. And as a result, we also saw 330,000 customers look for financial support through our app, which is a new service that we've had in place only for a couple of years.
We know that mortgage arrears hit a 7-year high at the end of last year, the final quarter of last year. The last time we had retail banks in front of us, they told us that, and I quote, the headwinds are ahead of us, not behind us, since many customers were still to remortgage. How many of your customers have now remortgaged, and how many customers have coped with the higher interest rates since remortgaging? How have they coped?
Well, in our case, as I said, those that flipped last year onto a higher rate, and the rates last year are higher than the rates at the moment. As Charlie said, mortgage pricing has come off significantly over the past few months. And in our case, 99% of customers that remortgaged last year are up to date on their mortgage, and 1% aren't, and some of those we've helped with the mortgage charter.
I'm specifically asking how they've coped with it. For example, have they switched to longer repayments for their mortgages? Have they moved provider? Have they looked for shorter fixes? What are people doing, or what are you doing to help people, and how are they coping?
Maybe Mr. Henry. So in terms of arrears rates, they've remained very stable over the course of the last 12 months. In terms of the comparison we talk about for NatWest, it's around 0.6% of mortgages are in arrears. In terms of what customers are, for those customers who do require support, 30,000 customers have taken advantage of the mortgage charter. We've been communicating the availability of the charter to our customers, and 30,000, similar to Mike, the majority of those customers have taken interest-only options. For those customers taking new rates, the majority of customers at the moment are taking 2-year fixed rates. I think when I speak to customers, that's because their belief is that interest rates are going to come down over that period, so they're opting for shorter fixed rates.
So it's true that the fears about the mortgage charter, that people would switch to interest-only rates, have been borne out. That's what your experience is.
I think it's important to put in context of 30,000 customers for NatWest is out of a total mortgage customer number of 1.3 million. So it's a relatively small percentage. I think it's very important for those customers that the support is there, and the Charter has provided very important support to those customers, but it is a very small minority of customers who've taken advantage of it.
And final question for all of you. What are your latest figures and forecasts for the number of repossessions you'll be experiencing? Vim? Yeah.
I'll start. On repossessions, as you know, the focus that we've just talked about, all of the forbearance tools and all the communications we're doing are trying to keep people in homes.
Understood. It's a very simple question.
And so it's a last resort.
Just looking for a simple answer
and,
to it.
And the simple position is that repossession rates are still in single figures a month for us.
And those single figures are?
Around 8-9 per month or so.
Okay. I think this is such an interesting area that we may need to follow up with and get some data from everyone on this. But John.
Thank you, Chair. Thank you. Morning, gentlemen, and thanks for joining us. The measures you mentioned previously about how you are adapting practices to meet your duties under the Consumer Duty is very welcome. But am I being uncharitable in suggesting to you that one of the key aspects or factors that would prove that the banks are really taking Consumer Duty seriously is the rates of interest that they offer on their instant access accounts relative to the Bank of England interest rate. I mean, latest figures, and these figures are dated the 12th of March, suggest that the 4 banks you represent offer rates between 1.4, I'm just making sure I'm not being too uncharitable, and 1.75 for instant access. Now, interest rates have been 5.25 since August. There does seem to be a big gap there. Why do you think that's a competitive rate you're offering? I don't mind who leads. Vim?
So I think the first thing to say is what we've tried to do is to focus our support on those who need it most. So we have a large proportion of society in our customer base that aren't saving, and those that don't have very large pots of money available from a financial resilience perspective. So we focused our efforts on helping those in greatest need. We've communicated a lot to our customer base, 10.5 million customers, around 10 times for 73% of those customers. And what we've seen as an outcome of that is 2 million people, 2 million savers are saving more in the last 12 months. So there's a piece around helping our customers, communicating them and helping them to save more. Can I
stop you there? I take all that on board, and I think the increased communication was part of the initial range of answers, and that is very welcome. I take on your point also about simplifying products.
Yes.
But at the end of the day, and I'm not just directing this at you, Vim, I'm happy to open this up, there does seem to be a disconnect between the Bank of England interest rate at 5.25, which has been there now since August, and the interest rates being offered by the banks. You know, you say yourself, Tim, that you're trying to help those most vulnerable, but those most vulnerable probably are better helped if they get a decent rate of return on the cash they're depositing with you.
I think what's important is the range of products and services that we offer as well. So we launched the Rainy Day Saver for our customers. That's offering 5% instant access for £5,000, and that is very much targeted at those in greatest need. And when you look across the range of our products that we've got, including fixed rate bonds for people willing to tie up the money for a little longer, a year or longer, and when you look at the outcome of all of that, we are paying our savers 7 times more interest in 2023 than we did in 2022.
I picked on you a little bit, Vim, and apologies. Let's spread this out a little bit. I still put it to you, though, that there is a disconnect here between the rates on offer. Typically, I know there's pots of exceptions, but the rates on offer and consumer your obligations under the consumer duty. Who else would like to come in and say I'm being uncharitable?
Well, Ms. Barron, can I just give a bit of context? I actually obviously agree with Vim. The starting point is 80% of customers have less than £5,000 of savings, 65% have less than £1,000. And for those customers, it's about building the saving habit and improving their saving habits. And I think you'll probably find across all of the banks here, there's a savings account for them specifically focused on those kinds of customers, offering something north of 5%, even 6% in some of our cases, for those customers to build a savings habit. That's the majority of those customers that is really important. The second thing that we have seen is most important in helping get the right return for customers is to understand what they're looking for in their savings. And there's 3 things that we really focus on. One is obviously transactional capability. The second is liquidity, access to funds when they need it. And the third is an interest rate. And for those that are looking for an interest rate and aren't looking for the cost of liquidity or transactional capability, which is a really significant part of how we serve customers, you have various forms of time deposits and then limited withdrawal products. Those are all higher rates than you laid out. They're all north of 4%. There are products that we have, for example, called a limited withdrawal product, where customers can withdraw 100% of their savings, and they are offering much higher rates, nearer the bank rate. And then the time deposits have typically in the last year been above the base rate. And what we've seen last year for Lloyds Banking Group, which was a good example of this, was obviously the same kind of proactive outreach. We contacted 15 million customers and showed them their options. 3.9 million new savings accounts opened. An increase in our savings balances in a very competitive market. So customers are choosing to put their savings with us, and a significant movement of customers taking money from their current accounts to their instant access accounts into their higher return time deposits. Okay. So we see it as an incredibly competitive market, and I think as Vim was saying, it's really that looking at the customers and what they need to improve their financial resilience and the scope of products.
Thank you for that. I accept the point you make about competition, but the Bank of England governor himself said in February, only last month, that, and I quote, bank rate has risen by 5.15 since we started to increase it in December 21, and on average overall effective rates on interest-bearing deposits have risen by just 2.5 percentage points. So I take on board that term deposits. I take on board that there are these special pots for instant savers to gain access to higher interest rates. But overall, you seem to have lagged the increase in interest rates. And in fact, I could perhaps go a little further and suggest to you that, according to the FCA, it took banks and buildings on average 3 months, just short of 3 months, in 2022 to respond to the Bank of England base rate increases. Now, I take on board there's all these little pots and special offers, but overall the Bank of England governor is saying, actually you're still behind the curve given the extent of interest rate rises. And meanwhile, the time lag has been quite noticeable as well. It does feel, and this is reflected in some of our correspondence we get as from our constituents, that the banks have been behind the curve in both offering higher interest rates and the time to get there. And these figures would tend to reinforce that, both from the Governor and the FCA. Now, if I'm being uncharitable, are you suggesting they're being uncharitable in their comments? Maybe we hear from somebody we haven't heard from.
I'd like to take that question. It's very good. It's a very good question. I completely understand where that comes from. For us, the most important thing to remember is that the bank rate is an important factor in the economics of banking, but it isn't the only factor in the economics of banking. So in very simple terms, for all of us sitting here today, most of our funding on the balance sheet comes from retail customers saving with us. And most of our lending goes to retail mortgage customers who borrow in the mortgage market. And as we were discussing earlier, mortgage pricing is fixed. So 90% of our mortgage lending is fixed. So we receive the same interest rate for a period of time, typically 2 to 5 years, each month, irrespective of what the bank rate is. We're committing to the customer that their rate of interest will be fixed for that period of time. So what that means is when the bank rate and interest rates go up, it takes a while for the impact of those higher rates to transfer into greater payments into our business effectively for mortgage customers because of that 2 to 5 year lag.
Yes, but may I suggest, and I did work in the city and I did run money. I take on board your point about interest rates and instant savings, but often what influences mortgage rates in particular is bond yields. Okay, now I'm not talking about bond yields, I'm talking about instant saving accounts. And that has a closer correlation to the current Bank of England rate than say mortgage rates, because mortgage rates are having to look out. Here we're talking about instant savers. I'd suggest to you you're still behind the curve on this, and that's the impression, or have been behind the curve, that's the impression that's been gained. I mean, let me put this question another way. It took nearly 3 months for the interest rates offered by the banks to start reflecting or start moving up after the Bank of England increased their rates. I mean, can savers now look forward to similar levels of responsiveness when the bank rate is on its way down? You said yourself it takes time, so it should act in reverse, shouldn't it?
I mean, I can't comment on how quickly or the extent to which bank rate reducing will lead to savings rates coming down.
That's not the question I asked with respect. I'm suggesting to you that the bank rate will be falling. It's anybody's guess when, but it will be falling. I think the general consensus is that interest rates have peaked. I suppose what I'm asking is not you estimating when the bank rate will fall, but whether the banks will have similar levels of responsiveness when interest rates went up. That sort of short 3 months average delay, so savers benefit when interest rates start coming down. Is that going to be how it's going to work for the benefit of your customers?
For instant access customers, we give at least 60 days notice of any reduction in interest rate, so there'll be at least 2 months because that's the rules that we have to adhere to, and so there will be at least 2 months lag on any downward rate movement. Okay,
and maybe even a little bit longer given how long it took to go up. Yeah. Final question, if I may. Sorry, Chair, just very quickly. The Governor of the Bank of England has also suggested that the low pass rate, in part perhaps, and I'm going to come to you if you don't mind, Paul, because I wouldn't want you to feel left out, is perhaps related to the fact, or the trying to regulation, such as the net stable funding ratio, is trying to encourage more stable deposits, given the past lessons. So there's been a move from instant to term, if that makes sense, deposits. I mean, to what extent is regulation playing a small part in this?
I have seen the comments by the Governor. What I would say, Mr. Barron, is there's been a really significant change in customer behaviour over the course of the last 18 months as interest rates started to move up and then accelerated. As Charlie alluded to, we've seen a significant amount of deposits move from current accounts to savings accounts and to term accounts. For NatWest, that's 17% of our deposits. There is more liquidity value in respect of fixed term products that would be there for 1 year or 2 years. But I don't think the regulation per se has changed that. I think it's more influenced by the overall increase in interest rates and the greater awareness that customers have. Okay. We've written to 8 million customers of the products and rates that are available.
Very finally, businesses are also making these comments that actually they're trying to find decent, and there's evidence in the constituency bags again that businesses have approached me directly, that they're having trouble getting decent term deposits from their banks. They can get no more than something like 2% when interest rates are 5%. I'd ask you to look at that, please, because smaller businesses in particular need all the help they can get.
On that point specifically, I'm very happy to say that there's term products available above 4% for small businesses, and
your bank
and customers are looking at that and taking those products out. Term products are not for every customer, though. Some customers value, as Charlie said, access to liquidity and transactions, but there are products above 4% in the market for small businesses.
Thank you, Angela.
Thanks very much. I want to explore the discrepancies, and they are quite large, between all of your performances on authorised push payment fraud prevention. Now, for those watching, authorised push payment fraud, as you'll know, is fraudsters who convince account holders to transfer money to dodgy places and then lose all of it. So for Barclays and NatWest, the payment systems regulator data generates fraud league tables, which showed that in 2022 Barclays only refunded 70% of authorised push payment fraud, and NatWest refunded 62%. But you both signed up to the voluntary reimbursement scheme, so why were your repayment rates not much closer to 100%, and TSB, for example, I think 91%?
Maybe if I start, I think this is a really important topic, and there are many facets to it. One is obviously reimbursing customers. I'm sure we'll get on to how we prevent fraud in the first place and how we prevent scams, and the role of many parties in this, including the tech platforms where 85% of frauds originate. The numbers I have for the reimbursements are 82% full reimbursement for 2023 and 12% partial reimbursement. So the vast majority of customers get reimbursed in line with the code that we've signed up to. There are further changes afoot for October this year.
NatWest?
So the first thing I'd say is I think the levels of fraud are increasing and the impacts on customers are life-changing. I've spent a lot of time at our fraud centres and listening to customers who've been impacted by fraud, and it's not only is it around concerns around the financial loss, but also the anxiety and lack of confidence that can follow from such an effect. So we take it incredibly seriously. I'm pleased to say from the numbers you quote, the numbers changed for 2023 for NatWest. We refunded 92% by volume, so there's a significant increase in terms of the refunds between 2022 and 23. But this is a really, really important issue because on average there's a fraud of £2,300 a minute, and that's something that all those involved in fraud, be it the banks, the social media companies, the technology companies, the mobile phone providers, really need to work together to limit the impact on customers.
So there's been a ramping up, is effectively what you're saying to us today.
Yeah, 23 figures are higher than 22.
Yeah,
yes.
You're doing much better.
Those figures are in the public domain as well, I should
sure.
say.
For Santander, the payment systems regulators published authorised push payment fraud league tables show that you were the second worst offender of the 14 designated banks when it came to the value of fraud being sent to your accounts. Why do you think that is?
Again, those figures relate to 2022, and the figures for 2023 are quite different. In our case, our volume of account push payment fraud is in line with our market share of current accounts, actually slightly below our market share of current accounts. So more recent performance has been quite different. And again, our refund rates are similar to what Pim and Paul just discussed as well.
So would you say that what's happening between 2022 and 2023 is that the figures and your focus on them has brought you more together in terms of performance. Do you cooperate on good and bad practice? Do you share information about where this fraud's coming from or what red flags to look out for? Or are you all in your own?
I'm happy to go first. So, it's, in my view, stop limiting fraud, limiting economic crime is a team sport. We all work together appropriately, I should add, to make sure that we can share information where it's appropriate. We do that with UK Finance. We do that between the banks. The targets here are the criminals, and that's we're trying to do everything we can to protect the end customer. There's only so much the banks can do. It's really important we also work with the social media companies and the mobile phone providers, because a lot of over 80% of the fraud is initiated on social media platforms. So the banks can do so much, but we really need to bring the whole industry, the whole variety of sectors together to address this.
Are you happy with the actions that the social media actors are taking to identify fraudulent centres of activity and not allow them to operate on their platform?
What I would say, and then maybe that there has been progress in terms of trying to address and talk to all the actors in the fraud chain, and there has been progress with technology companies and social media companies. But I would say that there is more all the participants can do here and need to do to protect customers.
The key thing is, a lot of this has come about because of the move online, and you'll be asked questions about access to banking later, but I mean, surely when more vulnerable people are moved online and they don't really have a choice, you've got an even bigger duty to make certain that they're not conned out of their life savings.
I can respond to that, because I mean the starting point is where Paul started, which is this is harrowing for any customer. I'm guessing have all spent personal time looking at the individual cases. When I was last in front of the committee, I think I claimed this was 40% of crime in the UK. The data I have is now nearer 50%. So the absolute laser focus for us, and I know it will be true for all of us, is trying to prevent fraud happening in the first place. And that's where your question around the role of the social media and tech companies is so important, because the percentages we all have are very similar, somewhere between 70 and 90% in any one period, is all being sourced there. The important point on your question just now, which I think is really important, I don't think actually it's online banking that is the source of the growth of this. In fact, what we've seen is it's really two things. It's the growth of social media, and when you look at how people are being victims are being affected by fraud, they are being found, targeted, talked to through the telco and social media platforms, and then they're being asked to do something, often through a digital banking channel, which is safer than prior examples. And all the patterns we've seen of fraud, some of them have been going on for 3,000 years. Building fraud, people being convinced to go in and take out their life savings and give it to a carer. These are the patterns. It's not actually online banking. In fact, online banking gives us better tools and better data to protect customers. It's how customers are being contacted and targeted by the fraudsters or the criminals in this context. And that's why I think all of us will sit here and hold arms to say, look, we're all committed to what the PSR is doing and the reimbursement scheme, but that's not where the focus should be. Helping reimburse people is important and really important for those victims that we see. It's far more important to stop them becoming victims in the first place, and this isn't as a result of online banking. It's as a result of the broader system. So I agree with Paul, there has been progress. Actually, some telcos specifically and some tech companies have really made progress. Others are behind. And when Anthony Brown was on this committee last year and was given that new role last year, we engaged heavily, I'm sure, all of us with him, and there was real progress in that. But it's not enough. And if you could look at the growth in fraud that we're seeing, we really need to work together and have more tools to work with those organisations to help us manage fraud. And then there's a number of things we're also taking with the PSR, with Pay UK. For example, faster sharing of data when we know when there are fraudsters that are often setting up their accounts, not on the high street banks. You've seen the tables showing that some of the smaller payment service providers, fintech companies, are 2,500 times more likely than we are to be setting up a fraudulent account. We're desperate to do more data sharing between us and do make that a more real-time thing to protect customers. So, of course, reimbursement's important, but you've got to look at the whole picture.
You were indicating you wanted to say.
I totally agree with all the things that have been said, and so I'll be really brief on top. Progress has been made, but a lot of all the parties coming together, a lot of those schemes are voluntary. What we have to do is mandatory. It would be great to see more progress there and really...
So you'd actually like to see more mandatory requirements on the whole ecosystem that we've been talking about?
Agreed.
With a focus on prevention.
Exactly, right.
Thank you very much. I just wanted to ask one very brief question about our sexism in the city report and about sexual harassment, but also about diversity. Have you read it? Are you taking it to your boards? And if so, what are you going to do about it?
Happy to go first. So I've seen the report. We welcome the report. NatWest provided, as I'm sure some of the other banks here did, provided written submissions. I'm pleased to say a number of the recommendations are already in place at NatWest, whether it's parental leave, whether it's not asking for salary histories, etc. We'll be discussing that as an executive team. So we welcome the report, and we hope for positive engagement on implementation of the recommendations.
I mean, there's a 90% difference in bonus pay, median bonus pay in NatWest between the genders. What are you going to do about that?
So you obviously have the numbers in front of you. That there has been improvements around the gender pay gap, etc. What I'm focused on is making sure that we've got, if you take gender as an example, that we've got equal. We're targeting 50% of females at the top 3 levels of the organisation over the course of the next 5 years. We're currently at 41%, so we are making progress. As females take those senior roles, that obviously impacts the figures that you spoke about, and they will change as a consequence of that.
Lloyds Banking Group's 59.4%, Charlie. What are you going to do about that?
Oh yes, I've read the report, and I really appreciate actually the committee putting a focus on this. It's been something that Lloyds Banking Group's been focused on way before my time there. We were the first to set out some of the targets for gender, ethnicity. We recently introduced disability. We take it very, very seriously. Our board is over 45% represented by women. My group executive committee is over 47%. My top 7,000 leaders is 40.1%. So we meet all of the Parker Review and the leadership gains. It's not enough, to your point. So we're very focused on how we can continue to make progress. We've got a lot of the...
4% median difference in bonus between men and women, even despite all that progress.
So I won't go through obviously individual names, but there's with respect to bonuses and then the pay gap, the two issues. Pay gap is slightly different. Is obviously we have 56% of our 65,000 colleagues are women. By far the highest percentage of our part-time roles are women. So they tend to be more junior. So the pay gap is the biggest driver of the pay gap is part-time roles. And the biggest driver of the bonus for me actually isn't seniority, it's which roles people are senior in. And for example, some of the commercial or wholesale banking roles or engineering roles, which are higher paid, tend to have lower bonuses. And so that's where we need to continue to work on the pipelines and provide opportunities to make that different going forward. And we are focused. One thing we're quite proud of is, for example, P&L roles. Normally the profit and loss leadership business roles are where a lot of the bonuses are. 3 of the 6 CEOs that report to me are women at Lloyds Banking Group. And that's really important because they'll also be the most likely to become the future CFOs, chairs and CEOs. So we're very focused on it. There's more to do, and we welcome the committee's focus on it.
Mike, 46.8% difference in bonuses, median bonuses at Santander.
Exactly the same reaction to what the others have said as well. This is really a really important issue. It's been a very long-standing issue for the sector as a whole. We were one of the founding signatories of the Women in Finance Charter back in 2016, and there is lots that we still need to do to look at not just at how we can make our workplace even more inclusive than it already is, and that's something we've done a huge amount of work on and we're very proud of. But just finding ways in which we can promote more women and recruit more women into the sector ideally as well. So if I look at last year, 46% of our promotions were women into senior roles. So the process is getting there, but there's still an awful lot of progress that we need to do. And like Paul, we're taking a report to our EXCO to work out what we can implement quickly to take those recommendations forward.
And Vim, it's 39.5% above.
So, I mean, same points in terms of focus on it and importance of it. My senior leadership team is 40% women, but we're also focused on obviously helping close that gap, but also on all forms of diversity, ethnicity being one of them. We will also be discussing that report and thinking of additional ways that we can start closing that gap.
Thank you.
Thank you, Chair. I'm going to look at the Business Banking Resolution Scheme and why it has proved so ineffective at getting compensation for victims who had their businesses, their homes, and in some cases their health taken by the unjust actions of Britain's largest banks. My constituent, Mr. S, is one of those victims. He's the former owner of a successful club and restaurant business in Chelsea. He'd banked with RBS until 1998. But in 1998, RBS's Global Restructuring Group were appointed as the receivers and attempted to hijack his property redevelopment to the tune of 4.9 million. Mr. S suddenly lost his business of 13 years, he was made homeless, his health suffered and his marriage broke up. The BBRS was created for people like Mr. S to access an independent dispute resolution service to have their complaints investigated, but like so many others, it has completely failed him. In fact, by the 30th of November 2022, the scheme only made 19 settlements in favour of claimants. Would you agree that the BBRS has failed victims? And that's to the whole panel. Thank you for taking the first one.
I think it's appropriate that I take the first one, but not appropriate that I talk about any specific customers' details in the forum. And I'm sure, I suspect there has been correspondence before, but I'm very happy to look at that specific example that you raised there, and I'll pick up with your office outside of the forum to do that.
I am sure, sorry Paul, I am sure that every member of this committee has had people in their constituency who have had similar.
We've definitely had evidence that the BBRS hasn't really solved quite a lot of cases. I think that's a fair summary, Siobhan.
A few things I would say. The BBRS, there's a lot of investment from the banks in terms of funding the setup of the BBRS. I think the take-up of cases, as you've alluded to, has been relatively modest. From memory, that just under 300 cases in total have been reviewed by the BBRS. That's despite relatively significant marketing and making businesses aware of the availability of the scheme, etc. There have been other resolution schemes that other customers have accessed. So I think the conclusion has to be that despite the marketing of the scheme, the number of the perception of the volume of cases that wanted to be heard haven't been through the scheme as it stands.
Even the number of cases who have contacted the scheme, the number of people who've received compensation of those people who have shown up and applied is very small.
And I guess that's, in many respects, that's also for the BBRS to answer in terms of their evaluation of the particular cases. We obviously provide a lot of information on particular cases that they're reviewing, and they come to an adjudication or a judgment based on the information that's been provided to them.
We've only had 10 cases go to the BBRS, and one of them was upheld. So very, very low volumes, very low demand. And again, Paul, in terms of the uphold rate, it is low.
10% in your case.
Yeah, but that's the whole point in setting the BBRS up, is it's there to do an independent review of those cases and judge whether it feels that more should be upheld or not, and that's in our case, it's only one case was upheld.
So my response is the same, and I think it's a good point of note, and I think we should take it away and come back with specifics around any recommendations we'd make around it. I think we'll all have the same data and the same response. Obviously, we understand the concern, and that's why we actually, as Paul said, invested to help set this up in the first place. We realised an independent body reviewing this was really important for these customers.
I have a question about its independence a bit later. The reason why my constituent was failed was that the scheme excluded claimants that were eligible for previous discredited schemes, like the victims of RBS Global Restructuring Group. Do you agree that the eligibility criteria for the scheme is too narrow and it missed the opportunity to provide justice for those victims? Sorry, Paul, that's going to be to you.
Yeah, my understanding is that there was a lot of discussion to make sure that the scope, at the establishment of the independent scheme, the scope was appropriate, and I know that was agreed by a number of different parties. So from the case that you're quoting, it sounds like that case fell outside of the agreed scope for the scheme. In the majority of instances, from memory, the scope was specifically because other cases had been heard through other schemes. I don't know whether that is the case in that specific example, but that was generally the reason for exclusions of scope.
How many victims were there of the RBS Global Restructuring Group scandal? And of those, how many have yet to receive compensation?
So I'd have to revert separately on some of the specifics around the GRG scheme. I know in the very long past there has been a specific committee hearing on that particular issue. I'm very happy bilaterally to share.
Yeah. Would you let members of the
committee know? Yes.
Yeah. Right. Thank you. And it's nothing personal, Paul. I hope you understand that. Lots of colleagues have called into question the independence of the scheme, given that it's a voluntary, bank-led and bank-funded redress scheme. When your colleague Andrew Harrison gave evidence to the committee, he told us that the scheme was independent of the participating banks. But having spoken to experts in the field, I'm not sure that's quite right. The eligibility criteria for the scheme could not be altered without the agreement of a company called the Resolution Service Appointed Member Limited, whose directors are representatives of the participating banks. Do you accept that Mr. Harrison is a director himself? And would you write to us to see if the committee has been misled?
I'm very happy to write to you. I don't know whether Mr. Harrison is a director of the company, but I'm very happy to take it away and provide the clarity which it's absolutely fair that you asked for.
Thank you. Charlie, just like RBS's Global Restructuring Group, the scheme's eligibility criteria explicitly excluded claimants that were eligible for previous discredited schemes, like the one headed by Russell Griggs of the HBOS Reading victims. I mean, as members of the committee, I'm sure will know that the Halifax Bank of Scotland, now part of Lloyds Bank, was involved in a major fraud at its Reading branch in the early 2000s. It took several forms, including imposing turnaround consultants Quayside, which then charged exorbitant fees and made up fees, abusing overdraft facilities and using what could be described as unprofessional bullying tactics. Do you accept that this constitutes a missed opportunity to provide justice for those affected? And do you recognise that there points to the need for a statutory scheme based on tribunals?
So just one point on the previous point. Banks fund most of the regulators and most of the independent bodies. So I think funding we need to look at separately from do we have the right governance. I think that's a really important point. On HBOS Reading, let me just take a start on this. First of all, I've apologised in my role, and I will continue to always apologise for the victims of the HBOS Reading scandal. We too had two employees who were found to be criminal and are in prison, or have been in prison. And I'm incredibly sorry both for the effect it's had on those customers and also the fact it's taken a long time to get to a point where we're trying to provide closure. As you said, there's been multiple independent reviews. We still have 2 independent reviews going on with respect to HBOS Reading. One which I have to say they operate incredibly independently, which would be appropriate, and hopefully you would support that. The one that's focused on trying to get complete closure on the 200 victims, approximately it's just over, that we still have outstanding, is being led by Sir David Foskett, and that's making progress, and I say good progress, very qualified, recognising it's 15 plus years since some of these events happened. So in the last 18 months, we've now got more than 90% of the victims have a status recommendation from that independent panel, and there is a fixed sum award which is available to those who have found who have been victims of this fraud of £3 million, and if they're not comfortable with that, they can then reapply to have their case individually seen by that independent panel. So I sit here and remain incredibly humble and sorry about what happened. We have now got an independent panel that's made progress. It is providing clarity, and it is providing a material level of redress for those customers that are found to be victims. And I think for those cases, which are very, very complex and long-standing, you need that level of investment and focus, and a body like that is what was needed in this case.
I've got a question on COVID loans. Is that okay? Have you got time, or shall I come in later?
Would you mind
Yeah.
if we try to get it in later? But you've had your advance warning on that one. I think I'm coming to Anne-Marie next.
Lovely.
Yes.
Thank you, Chair. Thank you for being here today. I'm going to turn to the issue of bank branch closures and the banking hubs. The number of branches has fallen to a level, we've got less than half that existed in the 80s. The rate of closure has been accelerating. We understand that is now going to slow down. But I think most of your customers are perplexed and don't feel they have any idea when these cuts are going to stop. They don't understand how decisions are being made. If you look at how the cuts have been made, the Southwest, which is of great interest to me, we've lost since 2012 45% of our branches, yet London has bank branch per capita at the highest rate. There seems no logic. Customers are very, very concerned, and they also do not feel engaged in these decisions. Letters go, if I'm lucky, to the MP. Letters will go to some of the key stakeholders, but there is no consultation with the community. Now, you are clearly private businesses, you have no obligation, but you are regulated by the FCA, and you now have a consumer duty. And it seems to me that ought to change the dynamic. I would like to know at what point we are going to have an end to the branch closures, whether or not this consumer duty will lead you to better engage with communities. And then finally on hubs, and I'll put them together because I think it is relevant, because the promise from all of you has been that when the branches go, there will be consideration of, and in many cases, the implementation of a hub. But that hub policy is fundamentally flawed. It was under-resourced. There are not enough people, there is not enough money, the sorts of places which are being established because you can't find sites, or Link and Cash Access can't find sites which suit. We have one hub in a public lavatory. I hope you are not proud of that. Right now we've got 33 open, but 109, which there is absolutely no hope, certainly with the existing criteria, of getting open within the 12-month period post closure of the last bank standing. And yet, and Charlie, I've written to you personally about all of this, because my branch in Teignmouth will be closing. There is no site identified. Yes, some have been surveyed, but the chances of either a temporary or a permanent hub being established by July this year are infinitesimally small. And you have not been prepared to look at extending the opening of your branch. Now, you have no legal obligation to do so, and your reply to me was you would work with Cash Access. Cash Access do not have the people, do not have the money, and they cannot magic properties out of nowhere. So I'd be grateful. I'm going to start with you, Vim, because I'd like you to tackle the branch closures, because it is your bank which has closed more branches than others in recent history. When is this going to stop? Are you going to engage with the community to meet your consumer duty rather better? Then I'm going to come to Charlie. I'd like to know about extending beyond the 12 months and what plans he has with regard to ensuring a hub is in place. Vim.
These are all very important topics, and let me start with looking at what's been happening from a consumer behaviour perspective. If we look at it over the last 5 years, branch usage is down 65% for us. App usage is up 120% over that period. So we've been responding to behaviour shift and consumer demand and expectations. I'll come specifically to the points that you raise. And as we have done that, we have increased the investment in some of the digital capabilities that our customers are demanding of us as well. I fully recognise that there are groups of customers that want face-to-face access, and therefore we've invested more capability and capacity into something called Barclays Local, where we do have colleagues in local communities. There are 380 communities that we are in now. We have continued to support cash access. I think we're at about 40 hubs now, and we will, certainly the latest data I've seen is that we will have 100 hubs by the end of this year, and we continue to support that as well. As you know, as you just pointed out as well, setting up a hub requires us to find a site, to get the premises on board, the planning permission and fitting out as well. We've committed that if we are closing a branch and a hub has been found to be needed, we will not close the branch until a hub is put in place or an alternative.
Even if that's more than 12 months?
Even if it's more than 12 months, we won't do it unless there's an alternative that is found in the meantime.
And what about the consultation, and what about the overall end game? Because what you're telling me, I think, is already well known and on the record. But what I need to know is, when will a bloodletting stop? When will we know when we've got to the end and we've effectively got to the end of the cull? And are you going to engage with local communities in a way that heretofore you have not?
So our strategy is actually increasing local presence. We will have 900 touch points. That's the commitment we've made by the end of this year. So we will have more touch points.
What is a touch point? Is it a hub?
So a hub, a branch, or Barclays Local will be the touch points. Barclays Local, our colleagues using various facilities in the community, libraries and the like, to help make sure we are close to communities.
And will you consult with communities? Because many communities find what you are suggesting inadequate for their needs. If you talk to the community, because there are big differences if you've got coastal rural communities as against inner city, are you going to engage with those communities when you make those decisions?
We continue to listen to customers as we make decisions. We look at the data as well to see how branches are being used and work out what's the best approach to help serve those customers in those local communities, whether it's a Barclays Local, whether it's a branch, whether it's a shared hub. And Link do the work to look at what's the right approach for each of those communities. The data is shared with them and they work out whether the hub is appropriate or not, and then Cash Access implement that.
Thank you, and I appreciate what you're telling me, but that's already on the record. I've heard about engagement. I've not heard anything about consultation. I've still not had a reply as to when the bloodletting will stop. However, I'm impressed that you are going to keep your branches open until a hub is in place. Let me then turn to Charlie. Are you prepared to make the same commitment?
So I won't go through all the context that Vim has. I think there's two other points that are important, though. So we have 1,010 branches, by far the biggest branch network in the UK. If it's okay, can I come? I did get a briefing on your specific branch, and I don't have it with me. So if I can come back to you directly, I think there's some news that we can share. But apologies, I don't have it to the top of my mind. I will come back on the branch you mentioned. So we have over 1,000 branches today. The dynamics that Vim's talking about, more than 50% reduction in the last few years alone. You talked about a 50% reduction since the 1980s. The really important point is we're guided by our customers. We also collectively and individually are investing significantly in the post office, so 11,000 post office locations, 37,000 free ATMs. When we talk to our customers, advice and support around key moments is important, but increasingly we see our customers can get better advice on the phone or digitally, because we can give them access to a more qualified individual. It's cash that's the complex part, which is why Cash Access UK and the focus around cash access is important. But we're investing significantly in the post office ATMs and then banking hubs. And I only give that context because it's so important that we do what our customers are asking for. And that's what our customers, when we look across, for me, 26 million customers, half the adults in the UK, the data shows that the vast majority are choosing to work through different channels and have got very specific issues. I will come to your commitments now, your questions in a second now.
This reminds me of the consultation at First Great Western. They asked passengers, would they prefer to have an at-seat service? They didn't say, and you're then going to lose the main cafe on the train. Had they asked the question in that way, the answer was, both please. Your analysis is I'm sure right for a chunk, and quite a significant chunk of customers. But there are others who want not just cash, but some financial advice and support. And I am very concerned that there seems to be a sense that because we have the cash access obligation from the FSA and now and in the legislation, that's been the prime focus. The branches provide something really quite different, and I'm quite frustrated that when you look at the hubs, if I go on the cash access site, which sets out for each bank what they will offer in those hubs, it's completely disconnected, and it's nothing like what used to be offered in branches. And when I look at that offering and I talk to Cash Access about the challenge of establishing these hubs, they tell me that because your systems are so different, one of their problems is they can't set up a printer which will work for all of your 4 different systems. So there is something about the way you're looking at these hubs, which is cash, not the rest of it, and you're not working together to look at how you can bring in something which actually works in an efficient way, given your different technologies. So maybe I can ask you, Mike.
I think it's a very important point, and you're hearing the strength of views from this committee on this subject. And I do send a message to all of you to go back and make sure that cash access and this whole process of banking hubs is working effectively, because from our point of view it isn't. Is that a fair summary, Anne-Marie? Because I'm going to bring in Therese on the same subject.
Thank you, Chairman. Mr. Maru, in October 2013 you had 1,577 branches. How many do you have today?
We have around 300 branches today.
Okay, so that's gone down from October from 346, and I know 2 more have already closed in my constituency since, and another one is about to close in May. What are the criteria that... sorry, can I ask the same question of the 3 other banks, please?
Santander, we have 444 branches. Last year we refurbished 49 of those, and we opened 3 new work cafes, which are
I don't need to know
places.
about those other things, thank you.
444.
We have 553 branches. We also have 41 mobile branches that cover 600 different communities across the regions and countries of the UK.
Okay, thank you.
And then we have 1,010 branches after the announced closures. So we have more than that today, and that'll take the rest of this year. And we have 150 community bankers.
The Times and Sunday Times are wrong, because they say that you have 599 branches as of October 2023.
You're talking to me?
Yes, I am.
Yes, they're wrong. They're probably talking about one of my brands, but I represent Lloyds, Halifax and Bank of Scotland, and we're the biggest bank in the UK, so we have 1,010 branches.
So 590.
And 150 community bankers that operate in the same way that Vim talked about as well, which I do think is an important model for getting the right kind of support for customers.
Can I ask each of you, how many are you intending to close within the next 12 months?
Well, my number includes those announced.
How many more do you anticipate? I don't need to know the locations, but but you will know how many branches you're closing. You'll have a running list of about 12 months ahead.
We have no plans to close any.
Thank you. Mr. Maru?
We have announced around 50 branches, I think, for this year, but I'll write to you to just confirm the exact number this year. But as I said, we're increasing the number of touch points, so we will have 900 by the end of this year.
So I've had complaints from my own constituency in Woodbridge of touch points being not particularly private when you go to discuss things. They're in a garden centre. They wait outside in the rain. So there's a combination of factors on some things not working, and I have to say they didn't listen to feedback. I mean, in particular, at the moment, I wanted to understand the criteria, because the information, in particular, I'm focusing on Barclays, because I have said this publicly, I'll say it again to your face. I think you're shameless and shameful in your approach to your customers. You make the majority of your profit now in the UK as retail banking, and it really does indicate that you don't care. So what's happened in terms of the information? It used to provide more detailed information when you said you were closing. Now, for example, in Leiston, it says 64 use the branch regularly, 80% use the branch and use other access. That isn't a lot of information to share. So what's the criteria on closing banks? And I'm happy to hear from each of you.
So, Neve, I'll start. And we look at many measures. It's probably around 100 or so data points that we look at. People visit local communities, look at the various criteria for that. That also helps us to work out whether a Barclays local would be helpful for face-to-face advice and guidance. I take your point and feedback. I will look into that. When I speak to my colleagues, they are very excited about the opportunities for Barclays local in helping serve communities. And then, of course, that all goes into the shared hub discussions as well as to what would be appropriate for the community as well. So we look at many data points, including the feedback from customers, but also the hard data around usage as well that you've just touched on there.
So as it stands, less and less information is being given to customers to justify why branches are being closed. What's the change? It's changed within the last 12 months.
I'm not aware of any change, so I can
go
away and look into
what
it.
Gets given here, there's a much more simplified version of what gets given out. My understanding is information goes to the FCA, but it's considerably different. If I give you the example of Felixstowe that closed in June 2022, it started talking about number of heavy users, and that was over 1,000 people, I think, considered to be heavy users. That's why I'm trying to get an understanding of what are your criteria on why a branch should close.
I will look into that and see if there's been any change. I'm not aware of any information reduction.
I can assure you.
Yeah.
It is. It's on your own website. It's different. I wonder if any of the other chief executives would share with us the criteria. I have heard Mr. Nunn talk about they listen to their customers. At the moment, I'm presenting a petition tonight about the closure of Leiston Bank, and it's been signed, I think, by about 3,500 people, combination of online and written.
I wonder whether, we do, it's not trying to obfuscate for the committee, we do have a long list of criteria that look through transaction and usage behaviours, feedback from customers, what we think the community needs, what the alternatives are for meeting those needs through alternative mechanisms. Some of those, as you say, have very strong oversight and scrutiny from both Link and the FCA. I'd happily share that.
I don't think Link scrutinises anything. Link is not there to scrutinise whether you close branches. Let's be clear about that.
The other point that I think may be helpful, tell me if you disagree, is obviously this has been happening for over 20 years. There's very close monitoring we do to ensure that customers, when a branch is closed and we have an alternative way of servicing their needs, what's their usage of the alternative channels, whether we see any customers moving away from us, what feedback we have, we track customer experience. And I wonder whether that would be helpful. One of the most important things for me is 97% of our interactions with customers today are digital, and the assumptions around which members of society don't use digital, I think, have been typically not right. And so I always talk to my teams around every community we're in. If you painted the door blue for Bank of Scotland and Halifax and green for Lloyds, we have a massive presence in every community, and we know, based on our own data, that customer engagement, feedback, usage of our services and the alternative channels remains very, very strong.
Okay,
And I
so
wonder whether that data would be
Nationwide has
helpful.
more than double the number of branches than Barclays does. Barclays, I think, and NatWest between them have got the highest number of personal customers. So let's move on, because I will continue to press the case on Leiston. Can we move to Link? So Mr. Mather and I were in a meeting with the Economic Secretary's Treasury and Link the other day. So far, as I say, the banks aren't particularly transparent in their information that they share, and Link so far had not been, but they've now shared with me the reasons why every application for a hub in my constituency has been turned down. In terms of the particularly thinking of rural seats, it surprised me to learn that the criteria, and by the way, Link works on your criteria that you have set, the banks, that they take account of the town, perhaps, or the village, whatever it is, and they might do a 1 kilometre extra circumference. And that doesn't reflect rural life at all. It doesn't reflect that people will travel into, get their haircuts, get their whatever, get their shopping. They talk about the number of retailers, and again, there's a lack of transparency. So I'd like to understand, I don't know which part of the country you all live in, but what it is why you've only set that as plus 1 kilometre.
Have you all been asked and trained to sit there writing down the questions and not answering and shuffling in your seats?
No. Sorry, I want to make sure I listen. There's quite a lot of content. Just on the 1 kilometre for Link, again, so I don't know the specifics on that, and obviously I'm happy to come back on it. Link is, I said, they look at the alternatives needed around not making the decision to close a branch, but for cash access, and that's the important point.
They do have your criteria.
They're only one part of the solution. We also have post offices, as I said, in 11,000 post office locations and counters, which we're supporting. And then we have other branches. So when you look at a region, we obviously have other locations. And then we have our ATMs, which are important, 37,000 of those. So it's, So
I do understand the issue about post offices, but also bear in mind the taxpayer subsidises a lot of rural post offices to the tune of £50 million a year. And by the way, that service is falling as well. So I'm trying to understand how it is that you're really responding to your customers. And don't get me wrong, I appreciate it's not your job necessarily to keep it. I'm conscious there's one other place in my constituency, apparently fewer than 10 people used it regularly. I get that. I understand that. I don't on others when there are businesses. And also you are setting the criteria. Now, it does worry me. Link are now going to look again at one particular branch, this one, Leiston, the petition's on today. But I think there are concerns that I have, Madam Chairman, that the biggest source now of crime is fraud. As it stands, Barclays in particular, and I do pick on you because you used to have 8 branches in my constituency, and within about 2 months' time you'll have 0. And that is the 40% of crime now that people engage with. And Barclays in particular, you talk about telephone banking a lot. And for me, I'm just really worried about particular people in society who are absolutely scammed out of existence and turn nowhere. And they used to be able to go to your branches, not just for cash, but as Mrs. Morris says, there are things like getting probate sorted for wills. There's all these other things which your local touch points simply do not cater. Your post office does not cater for. And your post office, a lot of your credit cards are also based on other things using barcodes, and post office haven't been given the equipment to deal with that. So this is why I'm concerned.
Yeah. And I think you can tell what an important issue this is for the committee, and we will no doubt return to it. Samantha.
Thank you, Chair. I'd like to ask you some questions about debanking, the sort of the why, who and how. So firstly, have the number of personal and business accounts that you've closed been rising in recent years? And if so, why do you think that is?
Maybe I'll go on, Mike.
Well, I can talk for Santander. So in our case, yes, it has. So particularly in 2023, and we expect the same thing in 2024. And the reason for that is we're doing a very extensive update on know your customer information on many of those accounts that we have. These go back many years. and some of them might be inactive or dormant. In fact, many of them are inactive or dormant actually. So as a result of that, we're closing quite a number. So we closed 37,000 accounts last year, 95% of which were for personal customers and 5% for SMEs. And the vast majority of that was because of this extensive programme that we're underway with at the moment.
And similar to Mike, we've been running a programme as well, trying to update information that we're required to hold on a regulatory basis with customers, and we continue to engage with customers and businesses to make sure that we've got that information, and we're contacting people 8 to 12 times to try and get that information. And of course, if we don't get the information and the updates to the information, then we are required to close those accounts. So that's the reason you see an uplift. That programme of work should be largely done in the first half of this year, so you'll see the volumes come down in 2024 from where we've been. There are obviously many other reasons too, so protecting people from scams and fraud is important. So where there's suspicious activity, we jointly agree with customers that it may be better to close the account and open a new one to keep money safe, as well as dormancy and inactivity too in accounts.
The banks have told us that they've closed accounts of SMEs due to reputational risk and risk appetite. To what extent do you think reputational risk and risk appetite are a significant reason for closing down personal accounts as well?
Our number of accounts that have closed, 23 compared to 22, have gone up, similar to Vin and Mike. It's for the same two reasons. A big regulatory compliance exercise in terms of updating customers' documents. We'd love those customers to stay, but if they're not able or not willing to provide the documents, then ultimately those customers will be exited. We also take our regulatory responsibilities incredibly seriously. The significant majority of our exits, over 97%, in information that's previously been provided to the committee, are for fraud or financial crime reasons. So any exits outside of that are a very small number. One of the reasons for that could be reputational concerns, but it's an absolute minority. It could, for example, be where customers are not operating within the terms and conditions of their accounts, maybe operating a business account through a personal account, or their account activity is different to what was expected, for example, very high cash usage. So in summary, reputational risk is a very small number in the context of the account exits.
And for Lloyds Banking Group, it's very similar. For the account exits, greater than 90% of inactive accounts, it's where customers are choosing to exit us, not us exiting them, and they're typically after 3 years, and there's good engagement. For the small percentage left, economic crime is the biggest reason. That is defined against a set of regulatory standards and criteria. When we talk about risk appetite, it's normally linked to economic crime, for us at least. We don't have any policy around political beliefs or reputation as a criteria, but as you know very well, the regulatory expectations around sanctions, money laundering and anti-bribery and corruption are actually in some cases zero tolerance. So there's a zero appetite for sanctions risk, and as you know, a very significant enforcement and fining regime from the regulators both this country and overseas. So that's why you're probably hearing us talk about we have to take a risk appetite decision for people that we may be suspicious of from a financial crime perspective with evidence of data, and we have to do that for regulatory reasons. And then for me, the only other reason, I can tell you the numbers, but they're tiny handfuls. The other reason is when customers abuse our frontline colleagues, that is a material but very small percentage, and we will exit for that reason as well. And I don't know whether you'd put that as risk appetite, but that's another reason that hasn't been discussed.
So there have been cases of reputational risk and accounts being closed as a result of it. So how would a bank make sure that the right decisions are being made around the closure of certain accounts in those circumstances? What's the governance around that? Who signs off the closure of accounts because of the reputational risk?
I think for me, certainly in my business, I can't think of anything material from a reputational risk perspective, and certainly we wouldn't be closing accounts based on political beliefs and protected characteristics, as well as Charlie said. We do have fora that would debate and discuss any of those risk aspects, and would make sure that there are checks and balances in the approach that we have taken to any exits. It's also helpful to see the regulators also give more guidance and advice on how we think about exit reform as well as we move forward.
Yeah, very similar. The decision to exit an account or a customer will never be taken lightly. We have customer decision forums that make sure that every case is reviewed on an individual basis, and we take into account all the different factors that would go into that. So that's how the process would work.
A recent report by the All-Party Parliamentary Group on Fair Business Banking claimed that lenders were freezing legitimate customers out of the financial system due to their opinions or lifestyles or because of cost. How would you respond to that? Would you accept that or?
It's certainly not a driver for us, and we have made some decisions around geography. So as we have come out of markets overseas, that has been a strategic decision that we've made, not to participate in certain markets outside the UK, which has led to some exits. But I certainly wouldn't say that we are trying to block people out of accounts. We're opening thousands of new business accounts and supporting many businesses to start up and grow.
Okay, thank you, Samantha. Keir.
Thank you, and thank you all very much for being here today. I'd like to ask you some questions about profitability, if that's okay. If I could begin with you, Charlie, please. When Dame Siobhan asked about bankers' bonuses in January of this year, the Bank of England governor said, bonuses are quite seasonal, so we do not know yet. If the banks were here, they would tell you that. If you look at their share prices and their so-called price-to-book ratios, it is not a happy story. Why is that story unhappy, and has it gotten happier in the last 2 months?
Gosh, yeah, so really, obviously important question, because my starting point for this is a healthy economy, and an ability to invest in an economy for customers for growth requires a healthy financial services system. I know from a profitability perspective we'll probably want to have a discussion around that the system does look like it has a higher profitability than it's had in the last 15 years, and not relative to history and not relative to other countries, but today it's higher. The issue is around investability that obviously the Chancellor and the Governor have raised. Our collective bank prices are trading materially below our book value, which is the value that we would assume the assets are worth through the accounting standards. At the start of the year, we were all trading on average at a 0.5 market to book. The equivalents for other countries, Europe would be nearer 1, not all of the countries, Nordics.
It's a lot lower than pre-financial crisis.
Yeah, well. The US is at about 1.5, Canada is higher, and Australia, there's Commonwealth Bank of Australia, which is another good organisation, is trading at 2.8 times. So why do I care about that? Why should we care about that? Not having capital and investors being able to invest in the UK financial system does weaken the resilience of the system. It also means the cost of equity, the cost for us to then use capital to lend to customers to support growth in the economy, is a higher cost than it's been. And so, we really welcome the discussions. It's a significant issue. What am I hearing from my investors? Because this is investors' view, and there's primarily 2 things. The first is certainty around the UK economy. The good news, if you like, around that is in the last 3 months, there seems to be a more positive outlook, more business confidence in the UK, and there's a kind of resurgence of international investors looking at the UK economy with a more positive outlook. The more complex one is what they would see as very significant uncertainty around the government and regulatory environment in the UK that is materially different from other countries they invest in. And of course, investors are only one stakeholder, but they don't have to invest in the UK and they don't have to invest in financial services. Mm-hmm. And we've seen a very large number of investors decide not to support UK financial services. So those are the reasons.
And Mike, if I could turn to you, sorry, I know you're scribbling away, but would you agree that recent increases in bank profitability have been driven by the increase in the BOE's base rate, which has given you more scope to increase your net interest margin?
Thank you for the question. That's a good question. I think Charlie's absolutely right. The fundamental thing here is actually looking at the profitability of banks across a number of years. So yes, 2023 was a good year in terms of bank performance, and we saw that in the results that were published by all the banks here today. But actually, for us, so looking at last year's performance, the return on equity that we made in 2023, which was a very good year for us, was 14.4%. And actually, our cost of equity, when you look at the price to book of our parent, which is a European listed bank, would indicate that actually it's high double digits. So even in a really good year, the level of returns that we're able to make in the UK aren't as high as the shareholders of our parent would expect. And the challenge, therefore, for us is, certainly in our case, because Santander Group operates in a number of geographies around the world, and equity and capital is pretty fungible. So the decisions that our group makes on a weekly basis almost is, where am I better putting my next euro of capital? Is it in the UK? Should I put it in Brazil? Should I put it in Mexico? Should I put it in the US? Where are we going to get the most return on that extra euro of capital? And at the moment, certainly, based on the competitive nature of the UK, the fact that our tax rates are higher than many of the other countries that we as a UK business are competing with for internal capital within our group, tax rates are higher. The cost of fraud is borne by the banks in the UK. That's quite unusual globally. And as a result of all of those things, when you look at it, if I were the group, I wouldn't be necessarily putting a lot more capital into the UK. I'd be putting it in other places.
And I suppose one factor in that sort of pie of profitability, as it were, would be in relation to central bank reserves. Would you be able to tell us how much interest income your bank earned from central bank reserves in 2023 and 2022?
I can give you that number. Sorry, I don't have it at the top of my head.
Would each of you be able to write to us on that point, if possible?
Yes,
that'd be fantastic.
sure.
Thank you. Could I ask you, Mike, building on that slightly, just about the sort of comms piece around the work that each of you do? You've sort of weathered the storm of coronavirus. The banks received a bailout equivalent to £137 billion during the 2008 financial crisis. If you look at the issue of bank closures, for every branch that you close, you save a yearly operating cost of £617,000. And this is in a context where, cost of living pressures are really acute for a lot of your customers, and you're benefiting from the base rate being higher due to things like energy shocks and the war in Ukraine. Would you sympathise with the view that many of our constituents kind of implicitly hold, that it seems like they struggle more and more, but the banks always seem to be insulated from these sort of headwinds when they occur?
Maybe if I could touch on a couple of things there. I think the points around financial stability have been well made. Mike made an important point about looking at things through a cycle. So when you look at the level of volatility and uncertainty that we've seen during the last few years, it's been difficult to really see where things were heading to. Certainly for my business, 2019 to 2023, the margin that we make, which is relevant from a profitability perspective, is broadly the same as it was in 2019. So I think that's one point. The other factor is that cost of living has obviously impacted consumers and businesses. It's also impacting us, and our cost base has gone up during that period as well. And then I think the points around branches and access to cash are well made, and we're very thoughtful about the people that want or need face-to-face guidance, which is why we're growing the number of touch points during the course of this year.
Could I ask you a question, Vim, just as follow-up on that, around the point of consolidation and its impact on your profit? Because in February it was announced that Tesco Bank will be bought by Barclays in a £600 million deal. Do you think the increasing sort of consolidation of banks and the reduction in competition is going to have a positive impact on banks like Barclays' profitability?
So what I can say is that we're excited about the acquisition of Tesco Bank, and I think what it shows is our commitment to the UK market, and I think that's a really big and important turning point as well in people showing confidence in the UK and feeling like some of the level of uncertainty that we've seen over the last few years is coming to an end, and people are feeling confident to invest more in the UK. So I think that's a real positive. We've got work to do to work through the regulatory approvals and the like, but we're excited about growing that business. We want to grow in the UK. We want to grow that business. and I think that will be positive for competition and the dynamics of the UK market too.
I suppose you guys should be able to make a good argument for, free market capitalism, lots of competition within the market. But what do you think the main risks of this increased consolidation are? Surely that's sort of inimical to a lot of the principles that allow a vibrant and dynamic banking sector to thrive.
I guess a couple of points I'd make on that is it is a very competitive market. You've seen a lot of new challenger banks come into the market. You've seen a lot of new neobanks come into the market. Not only banks, you have providers of particular products or services, for example, credit card lenders or foreign exchange providers. So I think that's evidence that there is a high level of competition in the market. We talked about some of the examples earlier in terms of the competitiveness of the mortgage market and the savings market. So to me, that indicates that it is a broad-based market with lots of participants who are competing very hard to serve customers well, and the banks that win will be the banks who serve their customers really well and understand their needs.
And just finally, because I'm conscious of time, Mr. Thwaite, in regard to NatWest being returned to private ownership, could you outline what difference you think that's going to make to your operations? And then if you also wanted to finish just on the point about the sustainability of profitability, given that the bank is forecast to cut rates soon, what will that switch over to private ownership mean for your bank? And also, will cutting rates have an impact on the profitability that we've seen in recent months?
The decision to sell down the government shareholding is a decision for the government and the Treasury. It's not a decision for NatWest. I've said publicly before, I'm very supportive of returning the bank into private hands. I think that is good for all of our stakeholders. I think it's good for the government. I think it's good for our other shareholders. I think it's good for our colleagues, and I think it's good for our customers. So I'm very committed to working closely with the government on that aim. I don't think in itself it's a direct driver of a change in our performance or profitability. What I'm very focused on is running NatWest as well as I can, and that therefore it would be an attractive investment for any new shareholder.
And on the reduction in the bank rate and its impact on your potential profitability?
We shared in our year-end results in February. We shared our view on where interest rates would settle during the year. We predicted that there would be 5 interest rate reductions in 2024 and a further 4 in 2025. That changes week to week, and the reality is the outlook for bank base rates will impact bank profitability, but it will depend, first of all, when that interest rate change happens and how many of them there are during the year. And so there's a whole range of scenarios there.
Okay, thank you all very much.
Thank you.
Thank you, Chair.
Thank you. I think we've got a few quick fire questions that may just go to maybe one of the panel. Siobhan.
Oh yeah, so the fact that you have such an important part in our constituents' lives and in the economy is why we want to keep asking you questions. So I'm not sure I should apologise for that, but I wanted to go back to the issue of the independence of the bank resolution scheme. To you, Charlie, on the 23rd of January 2024, Mark Grimshaw, Chief Executive of the scheme, told this committee that the eligibility rules could be changed with the agreement of the SME and bank liaison panels and the board. But according to the participation deed, the scheme cannot, and I quote, vary or purport to vary the scheme rules or the customer agreement, except with the prior written consent of the bank-appointed member. As a representative of one of those participating banks, would you suggest that Mr. Grimshaw might have misled us?
I don't know the details well enough to know. Do you mind if I come back to you on that? I'm happy to give a written response to that specific question. I just don't think I know enough to really give you a factual-based answer.
Of course, that's just kind of the independence of schemes issue.
I get it.
I've got another question about COVID loans. Is that okay?
A quick one to one panel member.
Yeah. We've talked a lot about fraud within COVID loans from the government and the private sector. And we know that there's going to be there is £17 billion has been lost to defaults, fraud or error. There was one particular example, a drug dealer and a car thief with 48 convictions who was given a £50,000 loan. Another case where the insolvency service found that a company that claimed on an annual turnover of £200,000 was actually making less than £700 a month. Did you just not do the checks that you needed to do, or were you put under so much pressure by the government that you just wanted to get the money out?
Who's that to, Siobhan?
Everybody.
I can say from NatWest perspective that we put all our usual fraud checks in place at the same time as the launch of the bounce back loan scheme, which I think is the scheme you're referring to.
In our case, we only actually offer bounce back loans to clients that we already had within the bank. So the incidence of fraud as a result was significantly lower.
We were the same as Mike. In fact, Vim, you did it. So you know the details. It doesn't take away from the fact that there is a small percentage of fraud, and as you know, the different players have different percentages. I know what my gross fraud and net fraud is, and it's significantly lower than some other participants, and some of those examples I'm sure you will find, because the other pressure that was on the industry, we were, I think, probably all sat around the table. We were really concerned about getting, for us it was £10 billion, significant amounts of lending out to support people that didn't have a pathway for getting financial resilience and support in that moment in time. So yes, there was a really strong coalition of the willing to try and support this. We did implement our fraud controls.
And I think it's the same, but I think the point that you make is right, which was, it happened very fast and very rapidly, and as the scheme was launched, people learnt every day to make sure that we got better as the weeks went on too. So, but it was important to try and get that running as quickly as possible.
Have you all did your checks? How come so much money is owed and has disappeared?
So we did our fraud checks, but what we didn't do was viability checks. That was the whole nature of the scheme, and that's why you do see people who aren't able to repay some of the loans. That was the nature of the scheme that was launched, and that's how it was meant to operate.
Okay.
Briefly, further to my line of questioning regarding instant savings rates and indeed term deposits relative to the Bank of England rate and the disparity there, would you be so kind as just to write to us, the committee, individually, 4 separate banks, and advising us what more you can do to close that gap, please, between what you're offering by way of deposits, both term and instant, given the bank rate is where it is, and perhaps intended policy on the way down when bank rates begin to fall.
Okay. All right. Request for a letter. Anne-Marie and then Therese.
Mike, I'm going to ask you to answer on behalf of you all. Banking hubs. Is the group of 9 looking at reviewing the criteria currently set for the hubs, because clearly the existing criteria aren't working? And secondly, are you looking at how you can integrate technology, how you work your systems to make sure that we can overcome problems like one printer which deals with all of you, and also some of the processes like how much money can you withdraw? For all 4 of you, it's different. For a customer, it's terribly confusing. It's going to make making these hubs work efficiently and effectively difficult.
So two questions there. So on the criteria, one of the reasons I was writing earlier actually is I was writing down Dr. Coffey's comment about this 1 kilometre thing in terms of the criteria. I wasn't aware of that. So I'm actually going to go away and have a look at those and see, and if I believe that there's a review that we should make of those criteria, then obviously we can talk to the scheme and try and bring some
that includes the size
action.
And the amount that you'll spend on them.
Well, we can look at the criteria of how that works. So I'll have to do that. If we believe it's not working for certain constituencies, we obviously need to make sure it works everywhere, not just in some parts of the country. And as for technology, this is really tricky because we all have totally independent systems where we do share technology like we've done with Link, for example, and we then effectively all build interfaces into our own systems that allow us to then provide services on a consistent platform everywhere. Those are actually quite few and far between, unfortunately. We'll have our own technology, our own printer configurations or whatever, exactly. So I think the challenge that we're all looking at individually, but probably also collectively as part of these hubs, is the purpose of them originally was to provide access to cash. That's very clear. That is the purpose of the scheme. But increasingly, I know a number of us, it was in the press this morning actually, have committed to providing other services as well through these hubs. The challenge for us is how we can enable that, and whether there are easy ways that we might be able to do that without trying to find very complicated ways of linking very complex processes across multiple banks into the hub kind of infrastructure. So there might be other ways in which we can do that, and it's absolutely going to be a priority to look at that.
When you've looked at both of those, if you could let the committee know what you find and what you propose, that would be helpful.
Definitely. And Therese?
Briefly on insurance rates, you can see that insurance rates seem to be soaring. Car insurance, home insurance. I wondered if you could tell us what you think is driving that, and what is happening with your own products, like I assume life assurance, travel assurance and similar.
Do you want me to talk about it? I do have an insurance company, so we do, I think of all of us, we have one product we do originate ourselves, which is home insurance, and we do resell third-party insurance company premium. On the home insurance, I think there's two things that are really relevant. The first is around home insurance. There's been an increased number of weather events, and then the cost of repairs has gone up, and so we do have to look from a cost up perspective at the increases in prices. Cost of living has impacted the cost of claims and repairs, and that's part of the issue. The second thing is, which I know a number of our customers have talked to us about, there was a new regulation introduced which changed how insurance pricing happened for first-time customers versus people who had been customers for a long time, to try and make it a level playing field. And for those that were looking for a first-time insurance policy, they thought the rates had gone up, or they were seeing the rates had gone up because of that change. That played out in the last 18 months. I think those are the two significant changes. It's we talked about competitiveness. 85% of mortgages are third-party distributed, 95% of cards and loans. Insurance is a third-party aggregator-led, very, very competitive market. So we are highly aware, where we control pricing, what this means for our customers. And so Dr. Coffey, again, is a really important point to raise. There are very clear reasons that we are trying to manage, some which are more changes in regulation, but some which are linked to the underlying cost of providing that service.
Okay.
Well, I was just going to ask the consumer duty.
Yes, no, by all means, yeah.
What difference has the consumer duty there had on the insurance market from your perspective? I don't know if that involves anybody else.
I could have a go. So we don't have an insurance business either, so we distribute third-party insurance. Okay, yeah. And in fact, the biggest change for us there has been, back to this management information point again, so we now collect over 200 pieces of data from our insurance partners, which is significantly more than it was previously, to understand how customers are using those products. And that then helps us in the design, and also helps us up front to make sure that those products are going to the right people.
And we don't manufacture as well, same point as Mike.
Thank you.
Thank you all very much. It's been a session where we've had a lot of interest and a lot of follow-up, so there will be no doubt notes exchanged on that. We want to thank you for your time today. I think it's fair to say that it is highly likely that our successor committee will want to have you back in a year's time to see how the consumer duty is affecting existing customers, because I think that seems to be work in progress. I think we've all noted how much you've had to change your behaviour in response to it, and we are looking forward to hearing further changes. I think you've heard concerns, particularly also about some of the bank branch closures and cash access, and I urge you to go away and look at how your organisations are making sure that works well on the ground where we see it happen. So thank you very much for your time today. Lots of follow-up by letter, and I'm going to say order.
Thank you.
The proceeding has ended. 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 The proceeding has ended.